and I think maybe the answer is like, let's not look at these things based on like last month or last week. And because a lot of people like to just take like last month and annualize it and then say expensive or cheap.
What does institutions are coming mean? Like, how does that process actually play out, in the time frame for allocating to these new asset classes?
So you can still have these crazy moonshot world-changing ideas take place, but it all kind of tethers back to like capital coming back to the original person investing in the thing.
Welcome back to The Roll Up. We are your hosts. I'm Andy.
I'm Robbie, and this is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Sit back, relax, and enjoy a quick word from some of our awesome partners who make this show possible.
Crypto UX? Broken. AI? Can't trust it. Let Magic Newton set you free. It puts your on-chain transactions on autopilot. Does all the work for you 24/7 so you can go do what you want. The vision of Magic Labs. The creators of embedded wallets. Used and backed by the best. See for yourself. Simpler crypto UX. Verifiable AI agents. Newton.xyz.
Pranav, we're here in New York City. Couple weeks before permissionless, a lot of movements recently in NYC with Solana Accelerate, NFT and NYC coming up. How you feeling, man?
Feeling great. I was telling my team this. I feel like sometimes crypto has more conferences than actual products to show for. So I would love for that to change at some point.
Wow, starting off hot.
It's like every 2 weeks there's like some conference and people it's like the same people showing up these things. I'm like, when are we building some real stuff?
Yeah, I mean, the city especially feels like a consistent weekly conference.
Yeah.
It's been a bit of a change, right? I was telling you that I've been doing a lot of the digital nomad stuff for a while and kind of always just, calling in virtual, but this is like every week there's happy hour, dinner, etc.
Yeah.
Which is good. It feels like the onshoring of the industry in a bit.
Yeah. No, that's definitely a good thing. Last few years, I've had to kind of travel around the world to see folks, and now I get to kind of see them all around here, which is really neat. Man, I guess I'm curious. What do you generally get out of conferences?
I mean, it used to be, so we first started like 4 or 5 years ago. And for us, it was all just a game of connections, like purely within like Ethereum and kind of like this community. So we would go and my partner and I would get as many telegrams as we could to try to get podcast guests, try to get sponsorships. Then now it started to shift towards being more strategic for like meetings, private dinners for, longer sales cycles, for meeting founders that we want to invest in our fund, or just kind of doing, now it's kind of just like fun.
Yeah.
Now you just go and you just have fun, do some panels, stuff like that. Yeah.
I'm starting to lean towards liking founders and teams that don't show up to conferences.
Really?
Yeah, because that tells me they're more focused on just building. But yeah.
What's funny is I used to say no to a lot of the institutional, like more suited up conferences.
Yeah.
I was just at StableCon last week and it actually felt much more of a compelling reason to be at these types of events because it's just completely new people.
Yeah.
And there's a completely new way of thinking. I spoke to like 3 private banks that wanted to launch stable coins.
Yeah.
And I was like, wow, okay, so we're getting a lot of stable coins.
Yeah. Do we? Why do we need all those stable coins?
I don't know. I saw this tweet that was like, there's going to be 1 million stable coins. And then it was like, bam, here's my DeFi product that is going to bring all of them into one. So anyhow, I brought you in today because I wanted to really get your perspective from your institutional lens per se. I think a lot of people hear the term institutional and have different meanings from it. I came to kind of understand that it's mostly just funds, right? It's people trying to allocate capital in the space in some capacity. I got in the space in 2017. We had this meme like the institutions were coming. We're gonna dump on them, right? We're early, like they're coming. And so, but I think people have a bit of a misnomer as to understanding how institutions actually move and operate in this space. So I would love to just get a bit of a baseline understanding as to, where are institutions like VanEck and others at as far as deploying capital into venture, into liquid, into stablecoin, stuff like this. Yeah. And then what does institutions are coming mean? Like, how does that process actually play out, in the time frame for allocating to these new asset classes?
Yeah. So there's many different directions we can go with that question. Maybe we can start with the premise of like, quote, the institutions are coming. And I guess like yourself, I've been generally involved in the space since 17 and been running our liquid token fund since 2022. So we're about to lap kind of 3 years. And so when I hear the term institutions are coming, it's either two things. One is like capital is coming in to buy our bags, as you put it. The other one could be institutions are going to build products that are going to be quote unquote on chain, i.e. tokenization of something, so that someone else can maybe use these things. So, and those are potentially two separate pools of institutions. So the folks that are building products, essentially tokenizing, recently were essentially a whole bunch of T-bill products like treasury funds, but you'll see other things get tokenized over time. You know, we obviously think equities will get tokenized, and we can talk about why. The folks that are doing that are a very different group of people than the folks that you ultimately want, quote unquote, buying your bags. Because the buying of the bags thing is really a downstream effect of allocators. So the way I think capital generally moves in the world is you have a whole bunch of people with capital, whether that's family offices, high net worth, endowments, foundations, pensions, sovereigns. So you can bucket capital, people who have capital, into just these categories. And ultimately, most of them don't make direct investment decisions. They either allocate to a passive strategy, i.e. an ETF-like product, or they allocate to an active strategy, which could be someone like us. They give us money to manage for them because they think we are experts in some area, and then kind of go ahead and invest that capital. And in general, those folks, let's just say every one of those verticals of pensions, sovereigns, foundations, endowments, RIAs, which are just essentially ultra high net worth people, and family offices, have kind of dipped their toes in a variety of different ways, but they haven't really arrived.
No.
I think the family offices came in probably early because they saw the return potential from this asset class, especially on the liquid side. But a lot of these people have kind of dipped their toes into this asset class maybe in two different ways. One is last year, they all kind of started buying some Bitcoin ETF because that was an easy way to get exposure. The other way is through ventures. So they found, your large blue chip managers to then allocate to. But a lot of them have not come into liquids or proxies of liquids, which are folks like us or whoever else. Talk about why and everything.
Which I think is where the edge is now, actually, more than before.
Yeah, so we've been saying for the longest time that in 2022, since 22 till now, there's about $60 billion of capital has gone into pre-seed seed venture, backed a whole bunch of founders. Many of these founders will likely want to exit in token form.
Yes.
Or maybe some of them will try to go public and so on. But going public is like a longer route than exiting in token form, right? Most companies go from seed round to public in 8 years. 6 to 8 years. Things go from seed round to a token in by 18 months.
Yeah.
So, and there are certain businesses where a token makes more sense than a public equity. Anyways, what folks are now realizing, these pools of capital that have been kind of dipping their toes, is maybe they've over allocated to venture because a lot of the investments they made through managers are ultimately launching tokens. And those tokens might have launched in the last 12 months, 24 months. And they all have one thing in common, which is their charts are generally down only. Because there is no like captive market to really take this off your hands, right? In the traditional markets, when a venture-backed company is about to go public, there's a deep public equity market of different types of strategies and allocators that are willing to buy those at the market clearing price. And that necessarily doesn't exist in the liquid token markets. And anyway, so I think point is like these people that have invested in venture are starting to realize that, and they're looking at liquids, but there's still structural issues with them ultimately pulling the trigger and coming into liquids.
Yeah. So my partner and I, Robbie, we run a fund that's just our prop cap. We probably did like 40 or 50 deals in the last like 18 months, 2 years, starting with like, I think the end of 22, we started really allocating through 23, and then through like the first half of 24, a lot. And then this year we've only done like one or two. We got a couple in front of us right now, but then I'm looking at the charts of Bitcoin or Hyperliquid or ETH, and I'm just like, Rob, like, Why are we going to put, 25K away for 4 years and pray for a moonshot
Yeah.
when there's a very clear liquid, gain in front of us for what I think is even this year,
Yeah.
or even into early next. And so our headspace has been around, I think what you're kind of describing, which is like this broader shift from, okay, allocating to pre-seed seed, because it was easy, if
Yeah.
you will. And like if you got the L1 trade in 21 and 20,
Yeah.
Avalanche, Phantom, Near, etc., those gains were unparalleled. And there's still a lot of large winners in venture, but it's gotten more crowded and more, there's just been a bifurcation of teams that are doing well and will drive returns, and those who won't. And on those who won't, that pie is getting bigger.
Yep.
And so anyways, coming back to kind of my framework, now I'm kind of like, okay, I don't really see the need to do that many deals unless it's a very select deal. And so I think, as you said, these early stage allocators are seeing the same thing, but there's kind of this friction for them to actually get in. So it sounds like that friction for them is opportunity for those who are in, or who have the ability to be in. Are you seeing this kind of like transition broadly with early stage capital allocators as well, similar to how I'm describing? Or even better, like, can you justify my thought process here? Like, am I thinking about this correctly? Like, okay, we're kind of midway through the cycle, or like, I think it's better to be in venture, or in liquid. Venture was good in the bear.
Yeah.
Yeah. Am I right? Am I wrong?
So
Like,
I think there are many aspects where you're saying makes a ton of sense,
Yeah.
right? Where like what I'd say is like the space where there's a clear supply demand imbalance is on the liquid side, because there's not enough supply of capital, and there's a lot of demand, i.e. a lot of tokens, a lot of projects to kind of look through and say which one of these are kind of like diamonds in the rough. Like reality is like 99.9% of tokens on CoinMarketCap are complete garbage, and like they shouldn't be like worth anywhere near what they're worth in the market.
Yeah.
But there are very, very small subset of opportunities where you can underwrite them. There's clear product market fit, and there's fees, and those fees are making their way to the token, where you could just very simply say, if let's just say, for lack of a better word, altcoin market cap, which is everything ex Bitcoin, ETH, and stable coins, which is 750 billion today, it's going to be multiples in the future. This project is going to be a direct beneficiary of that growth, and a lot of that value will go to the token. And this is a very easy bet to make. And this bet here is potentially superior to most things you'll see kind of in the pre-token market.
Based on time frame, or just like risk parameter, essentially?
Just risk adjusted,
Yeah.
right? And you retain liquidity, which is a big interest, like valuable thing.
Yeah.
Because you can change your mind. You can have a venture-like return profile with these assets and still have liquidity to kind of tell yourself, oh, I've been wrong on this thesis, I should be able to get out of this.
Yeah.
Now that said, the counter to kind of what you laid out, which is again a counter to what I do for a living, which is I focus on liquids. It's more in favor of what Wyatt does, who you I think had on.
Yeah.
Is that since 2022, since like the last administration has been so hostile towards the crypto space, one thing I noticed, and this is the thing that used to scare me pre-election, is the caliber of talent coming in to build applications on blockchains was like pretty weak. Like most great founders coming out of universities or wherever were just not coming into crypto. They were, building some AI app because that was easier to raise money for that, or whatever, right? And since the elections, I think a lot of interesting, talented founders are coming back in to build stuff. So I think if I'm just hypothesizing here, but if you were a VC that deployed all your capital in 22 to 24 and you were fully invested in a whole bunch of deals, versus if you're a VC that is starting kind of now and you're going to deploy capital over the next 24 months, my hypothesis would be that this cohort will likely have better returns than the last cohort, because you're just attracting better talent.
Yeah.
And so I think, especially in the application side, right, our application layer, because I think in general I've observed that application layer projects, even now, even with some really interesting talented founders, are pricing lower than, like, let's just say the next Me Too copycat, L1, whatever.
L2, yeah.
So I think a lot of the VCs are still kind of stuck in the past of like what's worked rather than kind of looking forward. So there is like, I think, a pretty great opportunity there.
Yeah, actually, I was speaking to Wyatt about that. Wyatt, for those of you who don't know, he's the GP of the VanEck Ventures arm, and he was telling me about some of the deals that they've done, and also that there's been this A16Z crypto event here this week, and yeah, just people with backgrounds from Stripe, from Visa, from PayPal, et cetera, coming in with that type of experience versus what I would say is more like homegrown, like developer experience, more like fintech, financial services, practical application kind of thought processes. Because we often get bugged down with like, being in the space for 8 years or whatever, you get bugged down with tribalism or of like the trade-offs of like the blockchain design or like, how many validators you have. But like, it does seem like this next cohort of founders doesn't really care that much about these things, just more about like product market fit or revenue or whatever it is. Which actually gives me to a funny point. I put out a tweet that was like, how long is the revenue meta going to last? It's kind of good bait, right? Did I put less than 3 months, less than 6, less than 12, less than 2 years?
Yeah.
It's funny. The results were very much like barbell. It was like, okay, it's going to last less than 3 months, or people put less than 2 years, which I assume is probably like, no, like longer or forever. And I got quite a few comments saying that this is something that's going to go on forever. Now, to your point about the elections, I think that actually was the first kind of domino, which is like, okay, you guys can build things now that make money, that accrue value back to your shareholders. Kind of like how we do in the whole world, but like you guys can't because we've had these weird rules. And then also Hyperliquid came about and was like, all right, well, screw VCs. We're just going to do it our way. And then we're just going to buy back the token in a huge way. So like these two things have really, I think, pushed that idea forward more than ever. So I'll just pose that question to you. Like, is this a fleeting thing or is this the end game? Is cash flow all that matters? Like, what is your view of perhaps even like the timeline of like this revenue meta? And like, is this a forever meta?
So I think it's binary. I think, it's either or, which is crypto will just be a sideshow of the internet if the revenue meta is not the meta, right? So like I think most large pools of capital in the world wants to either allocate to, let's just say, what is a store value, and then there's a small subset of things in the world that could be store value, let's say gold, Bitcoin, real estate, whatever. Yeah. Bitcoin kind of has made it in there.
It's getting there now.
And not everything can be that. Like, I think it's very hard to be that. And I mean, it's a miracle that Bitcoin became that, and that's cool. But everything else outside of that is ultimately going to be looked at as essentially a return of capital asset, which is I invest $1 in this today. How much money could it give back to me in 25 years or whatever? Take the most, like, nobody's asking, SpaceX, like when they'll start to return capital to their shareholders, right? But people are thinking SpaceX is worth X today because in 20 years from now, and when we're colonizing Mars, like here's how much money they can make and here's how much money will come back to us when that happens. So you can still have these crazy moonshot world-changing ideas take place, but it all kind of tethers back to like capital coming back to the original person investing in the thing. And that's like a bulk of like what the world likes to invest in or allocate to. It's like this framework of show me how I'll get a return on this money.
Right.
And I think for some reason, crypto has, as an industry, has really tried to like not focus on that. Now, part of that is regulatory, right?
Definitely.
Everyone's trying to like jump hoops to figure out how not to be called a security. So,
of course.
So then you kind of navigate yourself into like, ultrasound money or whatever. So like,
or store of value.
Because you always
community money,
right?
Yeah.
But I think, if we're just being truthful with ourselves, I think it's either the industry focuses on like the things that matter, which are essentially product market fit, and why is this asset valuable? And I think and just again going back downstream, when I tell people looking at our fund and asking what do you do for a business or whatever, and I describe what good token businesses are, the most often question I get before they even go in is like, why is this thing valuable? Because they're all used to the mental framework of stocks and bonds, and so for that money needs to come in, and that money will come in when the question or the answer becomes obvious. And then this asset class gets a lot bigger. So, or it doesn't get bigger, and we're all kind of like trading meme coins or whatever, which
so
is not great.
So the also the projection of future cash flows is valuable because I mean, if we're looking at the again, if we're looking at the revenue producing companies in the space today at scale, that would narrow down your focus with regards to assets that you would potentially want to hold. But then if you actually incorporate future projected cash flows, which is again how a lot of stocks and assets are valued in the real world per se, then that kind of opens up a bit more possibility for you.
Yeah. And what I tell people in general, so just to take a step back, our strategy could do both tokens as well as public equities. And so we can go where the best opportunities are. I don't have to, own alts if I don't want to own alts.
Yeah.
And in today's world, there's very few alts that we find interesting. But that said, I'm very happy to find a project that has a great product.
Yeah.
Where the token might not have any properties of value accrual today, but that's fine because these things are programmable and you can figure out value accrual later as long as you have a good team that is a good steward of sort of what they're building, and they don't have this. There are teams out there that have built a great product where a lot of the value might just end up going to the equity, and the token might just be like an irrelevant thing over the long term. And you obviously have to avoid that. But if there are teams that has built a great product and the token value accrual is not clear or the monetization of the product's not clear, but you can kind of use your imagination into the future and see how those things could work, that's totally fine. But that is an opportunity, right? Because if this product now gets monetized and that value goes to the token, then that token can go from being irrelevant to hopefully a top 30, and that drives the entire kind of fund's returns.
And I think that idea has been a bit it was done in such a way in the past in venture that was like, okay, we are going to build this product because it has it's a better infrastructure product than something else, and then we're going to figure out the token later.
Yeah. But
that's not what you're saying. It's like, no, this is actually something that's working consistently and is live in the market today, not, in a pre-seed round. And then obviously we can figure out a way to drive value back to that token. Yeah. And so coming back to your binary kind of lens of the space, when you're looking at these revenue oriented companies, how do you think about the right time to actually charge fees and to actually try to make a business of your protocol? Obviously you're coming at this from the investor's perspective, not necessarily from the founder's perspective, but every protocol has the competitive itch of knowing that there's going to be somebody that can undercut them, charge less because they don't want to charge rent and they want to get adoption.
Yeah.
So how do you think about the timing or the actual the adoption curve to, let's just say launch revenue, right? It sounds silly, but it's a real thing that you don't want to bog down your network effects.
Yeah. So that's a super interesting question. Because one of the things we look for in projects we invest in is, does this thing have a moat? And in most things in crypto, the answer is probably no. Because if you're asking the question, if I start charging for my product, will I immediately lose customers because someone will just charge less?
Right.
That by design tells you don't have a moat on your product, and it's easily sort of replaceable. So we try to stay away from those projects in general as much as we might use them as consumers. Because most, I think one of the things we all know is there are definitely great products out there, but that doesn't mean they're great businesses to invest in, right? And that's very much true in crypto too. There's a lot of great products out there, but doesn't necessarily mean they're great things to invest in. So so number one, I say, if the fear is fee switch equals loss of customers, then it's probably not something investable. But more importantly, there's a difference between charging fees and then returning those fees to the token holder. Right. And I generally believe that those things are independent decisions. Right now we live in this construct where if a fee switch for something is turned on and it's driven by a foundation, and the team that's actually doing the work to build the product is somewhere else in the labs entity. And what I would like to see in an ideal world is a product with a moat. It's capturing fees, and those fees are making its way back to the original team that built the product so that they can continue to build better products or different products that go down sort of it's kind of like how you would see a regular business, right? Which is take Amazon, they built a great e-commerce platform and they were able to use some of the cash flows or profits of that to build AWS and scale AWS, which then helps, they take now the profits of AWS and build Amazon ad services. Yeah. So the idea there is that, the management team of Amazon is a better allocator of capital than giving it back to the shareholder who can then has to find the next investment opportunity, right? So if like the ROI of that R&D is greater than just giving it back to the shareholder, it's like a good thing to do. I hope that the best crypto projects do that, which is, you know, if you find a founder who's built a phenomenal product with PMF and is able to charge for it and earn a lot of fees, rather than giving back to the token holder, I would say, you're a great capital allocator, built this great product. What's the next product you want to build?
Right.
Yeah.
Yeah. Yeah. And I think people misinterpret that when it comes to buybacks, right? They think that that's like a very, or at least as a token holder of a given protocol, you think that that is an efficient form of or usage of capital, but it's actually quite inefficient.
Yeah.
In terms of actually using companies' profits
Yeah.
to accelerate or to grow.
Yeah.
But again, token holders want to see that though.
In this current moment.
Yes, but that's why I think it's a meta, man. I'm telling you, like,
well,
I'm telling you.
I guess where I'm disagreeing with maybe some of what you're saying is like, I'm not saying revenue generation is a meta. I think the return of capital.
I think
is a
this whole focus on like exactly. Yes.
Yeah. Because
like the buybacks thing is like, we've seen it before. It's nothing new, right?
Yeah, but I think we're so again, let's separate those two things.
Two separate things.
I think every project should know how to monetize the product they've built.
Correct.
But needing to then give it to the token is just, I think, a moment in time thing, because we're currently living in a scarcity market in token land.
Okay.
Like this pool of capital that, again, like the TradFi, like you said, you know, pensions, endowments, that type of capital is not coming into the token market.
No.
It's primarily focused on Bitcoin and maybe some public equities that are, you know, crypto businesses, right?
Yeah.
And in that world where you have a lot of tokens and token supply growing and essentially a fixed market,
Yeah.
you know, the thing I tell people is like, again, take Bitcoin, ETH, and stablecoins out. Market cap for alts was like basically $1 trillion at the top of last cycle.
Yeah.
We're sitting in like 700 billion and change range. We got up to like 900 billion post-election, but like the market hasn't grown, right? So limited supply or limited demand and like substantially growing supply.
Yeah.
And so we're living in essentially a scarcity world. In that scarcity world, everyone's trying to figure out, what do I need to do to be the outlier?
Right.
And you know, right now it's like return of capital, like buybacks and whatever. But you know, I think there's definitely a world in the next 24, 36 months where the regulators will allow, let's just say, multi-token ETFs, where it's like, let's just say, an S&P 500 equivalent like product.
Yeah.
Where someone like this pool of capital that needs to come through me at this point or whatever might be able to just buy a passive product similar to the way they buy the Bitcoin ETF that gets them broad exposure to the crypto space. And that creates a funnel into the market, and this scarcity thing will shift.
Yeah, I think that combined with just macro as a whole, rates, stuff like that as well.
People want to go out the risk curve, and they'll come find their way to this. Yeah, that could be it too.
Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now, maximize yields on institutional-grade liquid staking with METH. Unlock $1 trillion of capital via FBitcoin. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle.
Tired of multi-chain headaches? You need Omni. Omni makes being on-chain feel like you're online. Perform any action on any chain in less than 2 seconds. It's all powered by SolverNet, Omni's breakthrough SDK for cross-chain speed, scale, and cost. To kickstart adoption, the Omni Foundation is offering $10 million in rewards for SolverNet-powered apps. Start earning today at omni.network.
So this may be a silly question, but there's a fabled secular alt bull run, right? Alt season, right? That people have been used to in the past. I personally think that Pump.Fun and the reduction in the barrier to entry has completely eradicated attention and capital allocation in terms of the attention span, in terms of the form of capital allocation. We used to be in a world, and perhaps we're still there, but we used to very much be in a world where you would do due diligence, you would do research, you would find some undervalued asset based on some core primitive that other people didn't know about, you would allocate and you'd wait. The dynamic has shifted so much to be whoever can be first and how quickly you can be to buy the first token or be in the, snipe the liquidity, et cetera, right?
Yeah.
So like that dynamic of like fundamental research per se has shifted towards just speed.
Yeah.
And I think that's caused a huge dislocation in the way that the market works.
Yeah.
But that being said, Bitcoin has also had this completely different structural regime than in the past, right? It's not the typical Bitcoin to ETH to alts that we've seen. It's just Bitcoin.
Yeah.
That being said, though, ETH kind of looks like it could turn around. We could get some alt movements. Like what is going to trigger a larger secular, let's call it alt run?
Like the summer to the fall of 2017, where you'd go on CoinMarketCap and like a different token would just be up 100%. It's just down the list.
Yeah, but even like, what's gonna stop the bleeding? Like it's just been a complete destruction. And I think a lot of people watching are investors in what they would consider to be like fundamentally strong projects. Also, I'm sure memes and such.
Yeah.
And are wondering like if this tide is going to shift. Like is Bitcoin dominance? Is it just up only? Like what is going to cause a structural shift in the market away from just like this Bitcoin and then like these like weird kind of pumps?
Yep. I wanted to just unpack one thing you kind of said there about pump fund and like people doing analysis to find an undervalued project. That whole thing.
Yeah.
I think. So I come from TradFi, and I used to live in the stocks and bonds world. One of the things when we would invest in any stock or bond, the question we would always ask is, who's going to buy this asset from me at a higher price at a future date, and how do they think, right? So essentially, like always asking who's the next marginal buyer and how they approach it. In crypto, it's become that the next marginal buyer is just a speculator, casino, gambler kind of guy or woman. Could be either. And so if you're putting on this like value mindset of like, I'm going to find this undervalued token project and sort of, buy that, then you might be right on every sort of analytical metric. But the reality is like the marginal buyer is not looking for that. They're looking for like some other, fart coin things.
Yeah.
But like, so I think, again, it's just a moment in time, and that could change as well. Right. So, But to your other kind of point on like how this market evolves, I think it's, again, I always think of this, I never have a certain answer, but I think there's probably two scenarios here.
Yeah.
One scenario here is like altcoin market cap again goes from the $700 billion number to like a much, much bigger number in the future. And that's because of tokenized equities. And I use that word tokenized equities in a very, very broad term. I'm not saying like it could be sort of things that trade on the NASDAQ that come on chain, and you're essentially giving access to that to like people in the world that they can't access today. That could be one way that happens. But what I'd love to see are more businesses, like regular businesses, like VC-backed businesses, choose to exit in token form than in equity form. So let the token have all the properties of what it would have if it was an equity, but then with this additional feature that is programmable and like it can do other things, right? Like, I don't know if you saw, like there were some headlines a few weeks ago that OnlyFans was for sale.
Yeah.
I mean, I think it would be interesting if OnlyFans had a token where that token was actually the equity of the business. Yeah. But then that equity would essentially, that tokenized equity is then used to reward creators that ultimately brought more viewers or whatever. Right? Yeah. You can imagine like how they could leverage a valuable asset that way. So this market of 750 billion can grow into something much bigger because real businesses exit in tokens than traditional way. So let's just say more on-chain IPOs than NASDAQ IPOs.
Yep.
And the other way is back to your kind of other hypothetical of like previous alt seasons where the existing set of assets actually just go up.
Yeah.
That one I could see if like we go back to giving people stimmy checks.
Yeah.
Like if you give everyone free money, then they just want to gamble, and like at some point they'll gamble on whatever that hasn't gone up in price.
Yeah.
Yeah. Which is a lot of the existing alts, right? If like once you kind of go out the risk curve and everything kind of goes up, like if you remember post-COVID, we gave everyone stimmy checks, we put a lot of liquidity into the system, like central banks were doing it, and like we had this fiscal stimulus. Yeah. The first things that went up were like credit stuff, like investment grade debt, high yield debt. Then the next things that went up a lot were essentially like the big tech stocks. The one after that were like these unprofitable tech stocks, like the ones you'd find in like ARCs, ETFs.
Yeah.
And then those things did really well. And then once those things did really well, people are like, what else can I do? Where's the risk curve? Like go out the risk curve. And then it was like the SPACs.
Yeah.
And then And then while the SPACs were doing well and they were all kind of like, the party was kind of starting to run out, then it was Bitcoin. And then it was like alt season, right? So it was kind of like, so when everything goes up, the thing that hasn't gone up will have to go up because people's desire to go out the risk curve is that crazy.
Right.
But I think that only happens if like rates go back down and then, we start giving stimmy checks to people.
Yeah. So the stronger thesis is actually not one of your current positions in the market may do well, right? In some more stimulated general economy, but it's actually rather that the non-Bitcoin market is going to grow significantly as a result of more assets coming on chain and basically becoming a large. It could be a ton of different things. OnlyFans, right? It could be actual equities and stocks.
Yeah.
But it's the
could be TikTok. I would love for TikTok to be an on-chain IPO one day, right?
Yeah.
Like good assets coming on-chain that brings people.
Yeah. Yeah. So it's really an expansion via a new mechanism via an onboarding.
Yeah.
So then how does that support your current liquid positions and thesis, right? Obviously investing in crypto and in equities as well. Where do you see upside or opportunity from a sector perspective going into Q3, Q4? We had Jordy from Selene on a couple weeks back, great guy. He was saying that he thinks it's going to be a slow summer.
Yeah.
He was like, it's going to be a slow summer because we don't have enough pain to actually get real stimulus from the Fed. The markets have already kind of rebounded from all of the recent tariff stuff.
Yeah.
And so just expect a slow summer. Does that kind of agree with your current positions or outlook? And then how do you position for what you're saying with these two outcomes?
Yeah. I listened to your pod with Jordy. That was actually great. So I'm not going to make any macro predictions because I've followed macro long enough to know that I have no edge in any of that stuff.
Right. That's how it feels.
Yeah, because like every month I see every headline about recession and like the economy is about to collapse, and then like the economy seems to be doing fine.
Yeah.
So I'm not going to make any predictions around that. But so my general view is all the assets that make up that $700+ billion altcoin market.
Yeah.
Most of those assets are not good assets. They're bad assets. They shouldn't be that valuable.
Okay.
Like if you make a list of L1s, once you get past, let's just say, you can even just do it very simply, right? Make a list of all the L1s on the market and then map how much fees each one generates. And you'll see that probably 3 or 4 chains generate a decent amount of fees. And then like the next 6 to 10 do no fees, yet they have like very large market caps. And they're all trading with this optionality that they can be eventually one of those that takes market share from the top 3 or top 4. But probability would suggest like it's generally low because that's not how these things work. So anyways, I think most of the things that make up the altcoin market are bad assets that aren't really valuable. So in our opinion, we're just trying to be disciplined and not have exposure to any of that stuff.
Okay.
I think we have to just wait until better assets come on chain. So then the question is, then it's like, okay, in this period, you're waiting for better assets to come outside of just like sitting in cash.
Yeah. Like, what do you do?
So where's the best opportunity to drive
for?
returns? Yeah.
Just own Bitcoin.
So here's where I think an interesting opportunity set is.
Yeah.
So I think obviously stablecoin legislation is about to pass. And on the other side of that legislation, we think there are going to be a whole slew of companies that will adopt stables to just improve the cost structure of their businesses.
Okay.
And so we started the year, especially post-election, making a very, very long list of public companies that, internet stocks, e-commerce players, gig economy players, all these types of companies, sports betting players, all these companies, and then examining how much of their cost base is fees they pay to the banking system, and then asking, can this business leverage stables to improve their cost structure? If yes, how much could they save it by? How could they theoretically do it? And then lastly, like, did they have a founder, CEO, management team that is actually motivated to do it? Or is this just a management team that's kind of like coming in to clip a check and then, move on to the next year kind of thing? So then that very long list turned into a much smaller list. But I think we've made some interesting bets there. I can't get into it in a podcast.
No, it's
but
interesting though.
Yeah.
Yeah.
But I think that's an area of the market where crypto investors aren't focused on that.
Yeah.
Crypto investors are more focused on the obvious opportunities in the public equity markets. And then the public equity investor universe is also not focused on that, because this whole stablecoin thing is not anywhere near what public equity investors are focused on. So,
Right. Yeah. And they're not even thinking about it either.
So I just think of it as a pure call option, right? If
Yeah.
a business I'm looking at, a public stock, can grow from, let's just making up a number, 40% gross margins to 60, 70 over the next several years because they leverage stables, then the money, they're going to make so much more money, and the multiple they'll get in the market is much greater. So that's where we're focused. We think that's where the kind of the asymmetric opportunity is today. But if we start to see really interesting token assets pop up that are valuable, kind of the thesis we're describing, we can pretty quickly pivot back if the return opportunity there is better.
Yeah, makes sense. So kind of dialing into this like L1 conversation here, there's been metrics thrown around about REV, RSOV, realized store value, realized economic value, just like a lot of stuff going on.
Yeah.
When you're looking at the actual landscape of outside of Bitcoin, is there a way that you're able to think about, let's just say the top assets which will survive in some capacity outside of the ones that are mostly overvalued? Like, I guess a better way to ask this is like, is Ethereum, Solana, and like a Chainlink or BNB, are these all also just completely overvalued because we're basing them on fees? Or like, do they get to have a little bit of that Bitcoin, monetary premium-esque ability?
I'll sort of take the no on the monetary premium thing. I think, it's hard to like get that. Like, I guess I could be wrong here. I mean, I guess there are people that own certain assets in the top 10 that really serve no purpose other than has like a crazy army, and they own those assets because they're viewed as a store of value, I guess. So there's irrational things in the market, but like, but I think most of the rest of the world will look at all these L1 tokens as pure kind of like multiple on cash flows type thing. And when you put that lens on, there's some that will look undervalued, some that will look overvalued, and some that will look fairly valued, I think. And I think maybe the answer is like, let's not look at these things based on like last month or last week. And
of course,
because a lot of people like to just take like last month and annualize it and then say expensive or cheap.
Yeah.
I think the better question is like, what do each of these things look like in 2, 3, 5 years?
Yeah.
And so like each of these chains have, let's just say, consumers of block space. For ETH, it's all the L2s. For Solana, it's, let's just say, a bunch of consumer-facing applications. Then the question is like, the people that are building today on these chains, if they got a lot bigger in the future, how much demand will there be for this block space? And obviously, these chains are also scaling their supply side as well. So, let's just say, both that scales. What is the REV number at that point, and how does this asset look relative to that?
Yeah. Well, I mean, it's just scary because if you think about it, if you try to apply any of these mechanisms, they appear way overvalued.
On
the DCFs or like stuff like that.
Yeah. So
like traditional cash flow mechanisms.
Well, I think it's then questions like, how do you look at them?
Well, I just don't think we can use these older valuation methodologies to value.
But are you looking at it based on like what this thing has done last month, or are you looking at it based on what it could do in 3 years?
Well, that's the question, right?
Yeah, I think the art is in looking at what it could do in 3 years, because like right now it's like, I mean, my best guess is like there's 50 million crypto holders in the United States, probably multiple times that globally. So let's just say 400 million crypto owners around the world. I don't know, how many active on-chain users do we have? 10, 20 million, 30 million, something like that, if you're generous. So if you believe that, let's just say it's 30 million, that's growing at some cadence year on year. If you think it's like it's going to grow at 5% a year type thing, then like this is the entire industry is overvalued. But if you think the on-chain user base can have essentially like what looks like a ChatGPT moment, where ChatGPT went from like no users to like this hockey stick and hundreds of millions of users. If you think the on-chain world can have that, and in 3 years we have 500 million users that are directly using apps on-chain, or not even directly, or just using something, but it's really creating an on-chain action. then I could make the case that certain of these chains are kind of undervalued.
Yeah.
Yeah.
Yeah. And what's fun is that we focus so much on infra in these conversations about the top chains, but like the populist polls now are very much in line with apps.
Yeah.
It's very much gone from no revenue to revenue and infra to apps very quickly.
Yeah.
To the point where people are kind of putting together these, fat app thesis per se, formerly known as fat protocol thesis, all the way to the fat wallet thesis.
Yeah.
I'm just curious how much you think, how important it is to actually own the user relationship from a infrastructure perspective. So like if you're looking at a Solana or an Ethereum, right? They've got a ton of developers that are building on them their own applications. Phantom Wallet for Solana, MetaMask, right? But these are not necessarily owned by the infrastructure stack themselves. They're third-party companies building that out themselves. When you're looking at this kind of infra to app shift and this user relationship, even if we want to call it chat GPT moment where it's owning that, like how important do you think that is for infrastructure based teams now? And like, is that where you think there's a lot of room for growth in the space if we want to get to that chat GPT moment?
Yeah. So, I think of the question a little differently, and I think I'm going to give you like a non-answer answer, I guess. But we haven't seen like a true killer app on any of these chains decide to quote unquote leave whatever chain they're on and start their own chain and own the full stack, right? Because if they were to do that, they're essentially saying, I own the user, so everything below me is kind of just a commodity, and I can just rip and replace all that and then own the entire profit stream of that and have no impact to my user relationship. We haven't seen that.
Yeah.
But if and when we see that, and how that plays out, right? Does the app then all of a sudden lose a bunch of users for whatever set of reasons? Or does it just enhance the experience for the user, and all of a sudden that application is now making more money because they're not leaking value to all the infra that we're using? When we know the answer to that, that's going to tell you like directionally where you want to go with this. I don't think we have a great answer yet.
Yeah.
My hunch is that if you own the user, you own the experience, and everything else is a commodity. That's kind of like my general view, because that's what we've seen in other industries. But then again, you have things like, the cloud, the hyperscalers, where like essentially Amazon, Google, and Microsoft essentially having over 2/3 of that market. And you could have like these, let's just say infra L1s play out the same way, where it's like a 3-player market and maybe you switch back and forth between the 3 players, but it would never make sense from an economies of scale perspective to do your own thing. So it could be one of those. I don't think we know. And that's part of the value proposition of being liquid is like, we're asking this question, we're monitoring for answers. And I think we would be able to react quickly when we have an answer in terms of how we tilt our book, right? So if it turns out that like killer apps eventually can just rip and replace all that infra and just be their own thing, then maybe the answer is owning L1s is not the right thing to own. And you can make that decision we can make that decision within hours. Yeah.
Exactly. Yeah. I think there's a lot of power in being liquid today. And I generally agree with that viewpoint about the user relationship, the data, and the brand recognition. But it's just been so opposite in the space where like the underlying infrastructure has accrued all of the brand. Yeah. Right. It's like Ethereum is the brand. Yeah. But like you don't use Ethereum. Like you use Ethereum, but like you use something else. Yeah. Right. And so that's just been kind of
I think what's interesting is I think maybe there's a different question there, which is do you think crypto goes mainstream from a consumer perspective? Because existing Web2 players decide to build on these things or leverage these things? Or do you believe crypto goes mainstream because some VC-backed seed company creates killer apps? Because if it's like, the projects you're looking at and backing, the projects that Wyatt's looking at and backing, those are the projects that ultimately yield killer apps, then their decision tree is essentially, at least from what I see, is which chain should I build on to show traction the earliest so I can then raise my next funding round so that I can continue to build. So it's basically, 2 years ago, remember in 22 and 23, everyone wanted to build on Ethereum or an L2 because it was easiest to show traction there to then raise your next round.
Yeah.
And that has now kind of, in my opinion, flipped.
Completely.
Where it's easier to show traction on Solana, so that's where it is.
Yeah.
So now, but that said, I don't think there's a killer app outside of Bitcoin and stables yet. So we don't know if like a lot of the apps that have been backed, like, are they the right litmus test to answer that question? Now, if it turns out that like, I don't know, WhatsApp having a stablecoin experience is like the next interesting thing. I thought I saw some headlines around that a few weeks ago.
Yeah.
Then why would they leverage any of these blockchains?
Yeah, exactly.
Can they just
or build their own or whatever it is?
Yeah.
Yeah, interesting conversation with Kenny from Mantle Network. They're kind of in a place of like, okay, we've got this L2, and like, what is our app?
Yeah.
Like what is our reason for existence almost, right? And thinking deeply about like how to create something that is compelling. And I think that it goes towards what you're saying is like, okay, if they could just build something that is removed from blockchain almost in of itself, like a typical application on the App Store or a typical web app, and then just link it down to these chains at a later date, or figure out some way to kind of reintegrate. Like I'm just not sure how we go from like the current experience and the current application builders to like these next killer apps without kind of like maybe walking some steps back as to how we think about building products in the space as a whole. And so I think a lot of like L2 builders are having this like kind of like moment of reality per se.
Yeah.
You look at the TPS and some of the L2s on Ethereum, and it's pretty sad.
Yeah.
So not sure exactly where we go from here.
Yeah, I mean, look, everyone has a different reason they're in crypto. My rationale when I left TradFi to come do this was because I thought well-designed tokens can be an incremental capital structure instrument for companies, and tokens in their right form are better than stocks and bonds. Like, that was my simple thesis. So like, if Amazon stock was just a tokenized Amazon stock, Amazon could have grown Prime way faster than the 14 years it took them to build Prime, because they could have used it as rewards to grow the thing, right? So I'm here because I think tokenized equities are a thing. And then the question is like, what are the things you need for that to manifest itself? Like, do you need the most decentralized blockchain? I don't know, right? I think what you probably need is something that can create a great user experience.
Yeah, I mean, that's at least where the market has certainly shifted towards.
Yeah, I think the customer in that example I gave you of tokenized equities is the issuer, i.e., in my hypothetical example, it's Amazon, right?
Yeah.
And so the question is, what do they want? And then kind of work backwards from there.
Well, we're gonna figure it out one day, 1 week, 1 month at a time. Space is honestly in the best place that it's been since joining, but also it feels like the sentiment feels very weird as well. So I know I'm glad to be here. I appreciate your time today, and thanks for joining.
Thanks, man.
It was
It's been fun.
Cheers.